In this tutorial, I'm going to be showing you how to trade successfully with leverage. People are always asking me, what leverage should I be using? 100x, 1x leverage. People are always getting liquidated. People are always losing on leverage. And in this video, I'm going to be sharing with you a few tips and tricks that if you follow these rules, you will not lose many trades at all and never be liquidated. Let's get into it. So, when it comes to trading leverage, the key thing you have to keep in mind is risk management. This is the most important thing. You do not want to be putting too much on one trade. You do not want to be putting your whole account balance on one trade, using isolated high leverage. I'm going to go over the different types of leverage you can use. You need to be trading in a way that when the market pushes against you, you are not going to be liquidated. You need to understand whatever coin you are trading, that how far during a correction or a pullback or a crash, or how high these coins could potentially go up or down against you, depending on whether you're long or short. You need to be positioned in a way that if the market squeezes and pushes against you, you are going to be totally fine. This is very important. This is what is going to keep you alive. So we are here on Blofin. This is a platform that I highly recommend trading. You're going to have the cheapest fees, and you also get deposit bonuses if you sign up using my link. So I highly recommend you trade here. If you want to learn how to use the basics of this platform, go to YouTube and search how to use Blofin or any of these platforms. But this is for people that already have some form of understanding of how to use the platform. So first and foremost, when it comes to trading, what I'm going to do is I'm always going to go into the settings of whatever trading platform I'm using, especially a leverage trading platform, and enable hedge mode. This is very important because it will allow you to open short positions and long positions of the same trading pair or coin that you are trading. That is one. The other thing is I'm always using cross leverage, the highest leverage possible typically. And I'm going to go to Bitcoin, for example. Currently, I have some underwater trades at the moment, but they will be in profit very, very soon. So I'm not worried about these trades. So when it comes to Bitcoin, I trade Bitcoin. I also trade Ethereum oftentimes. I'm using 100x leverage on cross. Cross means that if the market goes against me 1%, I'm not going to be liquidated on that trade. Because if you use isolated leverage, click isolated leverage, and the market goes against you on 100x leverage about 0.8%, that position will typically be liquidated. It's gone. So you have very little room for error. And when it comes to trading, if you are not perfect, you are going to lose money. And oftentimes the market, you are not perfect. Oftentimes the market will do and move against you more than you think. So use cross leverage. And you also want to have, when it comes to trading leverage, when it comes to your trade size positioning, you want to be able to essentially be risking about 1%, 2%, 3% on the higher range and maximum like 5% on a trade. Meaning that my position size, if it goes against me 1%, my account should only be going down about 1%. Maybe up to 3% for every 1% move on Bitcoin. So you need to figure out the math of what that is for you. So for instance, I have nearly $100,000 account and I have about $2,000. Usually it's about $1,000 to $2,000. Sometimes it gets a bit higher on 100x leverage. So that means every time Bitcoin moves 1%, my account is only going down about 1 or 2%, give or take, more or less. So that means Bitcoin can squeeze against my account massively. It can go against me like 30 or 40%, more or less, and I'm not going to be liquidated. The reason why I don't lose any trades for the most part is because I'm risking small. I'm not risking much of my account. And when the market pumps against me, guess what? I'm totally fine. This is the most important thing. And the same thing with whatever coin I'm trading. But one rule I highly recommend that will reduce pretty much all liquidations and all losses is do not trade altcoins. Do not trade them. If you trade Bitcoin only, you will pretty much never lose a single trade if you follow my risk management tools and the things that I'm mentioning to you now. So cross leverage, and guess what? I'm only trading Bitcoin for the most part. Yes, you see me trading Ethereum, but I'm a professional trader. you are not a professional trader, most likely. So do not think you are a professional trader. Get real. But it's even rare that I do trade Ethereum. I only trade altcoins during very, very extreme times, and I'm only looking to scalp, get in and out very quickly. Okay, here is the other part of my trading strategy that if you use and implement, it's also going to prevent you from losing much money. So let's get back to Bitcoin. So as we can see here, I've been opening some longs and the market has dumped against me. So not a big deal. That's very, very normal. I'm not going to always long the exact bottom. But what I can tell you is that I've been scaling into this position, our dollar cost averaging, and this is what you want to do. So let's say my regular position size is $2,000 on 1x leverage. That's my regular position size. Or I could say my regular position size is $5,000 on 100x leverage. Let's say that that is my position size. And I'm using these numbers so you can understand. This is not necessarily true of my trading strategy. So what I will do is I will typically open a position size. I will open a position. Let's just say I open a long position here. I think the bottom is here. I'm not going to go my entire position size that I normally go all at once. No, what I'm going to do is I'm maybe going to go 1/5 or 1/3 or something impartial to my full position size. Because if I long here, the market crashes again. I long here with that same exact sizing. Like let's just say I open $500 here. I open $500 here. Now guess what? My average price is going to be in the middle. It's going to be here on this yellow line. This is my average price. So when Bitcoin bounces up a little bit, guess what? I'm going to be essentially in profits. But if I go all in here too aggressively, too fast, and I'm overconfident, oh yeah, this is the bottom and the market crashes against me, guess what? Now I'm going to be underwater. And yeah, over time, eventually it's going to bounce up to break even, but I'm going to miss this whole entire move. So if I scale in and I'm looking for long positions, guess what? I'm not going all in. And eventually, if you scale in slowly, once the market actually goes in your favor, you can be close to full position size or in profits, and both at the same time. And then what I will do, in addition to just dollar cost averaging every time it dumps down further, I'm going to add more to the trade once I'm confident that the bottom is in, adding more size to the trade. So therefore, eventually, when I keep adding more to my position size, it's going to bring my average entry closer to the actual price. And then when the market catches its move up, I take profits and I'm going to be in profits. The other part of this strategy and a couple of other things that you can use and implement is you can use a stop loss, but put it in a way that it's never going to be hit, but it's going to protect your account in case some type of black swan event. So for instance, I could put a stop loss here, maybe under these lows here. If there's a huge crash, I will get stopped out. And if it goes super low, then I'm just going to reopen my trades and make up the losses back. This is just an example. It's not necessarily something that I would typically do, but a stop loss is there to protect your account during a black swan event. So this is something that you can consider. But you have to understand, when you take a loss, when it comes to leverage trading, you need to be able to get back in that trade very quickly. Because most of the times, if you get stopped out, the market's going to bottom or bounce from near that level. And you need to be aggressively entering back in. If you took a big loss here, like 6,000, 10,000, and the market liquidates everybody, you need to get back in, start getting back in and making up those losses back quickly while there is momentum. So stop loss, something that you could potentially use to protect your account in case there's a black swan event. Now, this is typically how I will add to my position. I only use market order. I do not use limit. I'm going to come here to market. I'm going to slide this little thing over, and it shows me how much I'm adding onto the trade. So I'm adding another $100. So I'm going to press long, and notice that it brought my average price down lower, adding more margin to the trade now that the market's starting to bottom and bounce up. So that's typically how I'm adding to positions. I'm not adding by adding the margin. There's an option to add margin. That's not what I'm doing. I'm adding to the trade by opening the same exact trade. That's augmenting or adding to the trade. If you ever get yourself in a pinch where you are about to get liquidated or the market's squeezing against you, in hedge mode, you can also open a short position. Like for instance, I can open up a short position here, and look, now I have a short position open. So if you open a short position in the same exact or close to the amount that you are trading, you can never be liquidated. There's essentially an infinite liquidation price. So that's something to consider. When it comes to leverage, you don't want to be holding your trades super long. You want to, if you catch a big move, take profits. And if you keep taking profits over and over again, you have to understand the market is highly volatile. It's always pumping and dumping constantly. So if you have a huge profitable trade from here and the market pumps and then dumps all the way down, now you're going to be underwater. You're going to be getting liquidated. You're going to be stressed out. You're not going to be able to sleep. So always take profits aggressively. Now, when it comes to making entries in the market, what you typically want to do is you only want to trade during very extreme times. So after a very big move, this is when you want to be getting involved. You don't want to be trading leverage when Bitcoin is barely moving and doing something like this. You do not trade during those times. You only trade when there's high volatility. When Bitcoin pumps up like 10%, what you want to be looking for is after a big pump, you want to be looking to fade the move back down while people take profits, unwind their leverage, and the market pulls back a little bit. You're looking to capture just a portion of this move. Also, after there is a huge crash or dump on Bitcoin, once the market starts to show sign that buyers are coming in, this is when you want to start scaling in slowly into long positions, waiting for the bounce, and then aggressively taking profits after the bounce. Another thing, when to take profits is you want to be giving your trade room to breathe. You want to allow the trade to play out, so don't be too aggressive. But essentially, after a big pump, when you start to see weakness during a strong trend where it's kind of like moving like this and slowly rolling over, that's when you want to go ahead and exit. The same thing with shorts. If you're shorting, the market crashes and starts to look like it's bouncing, that's essentially when you want to exit your short positions. And you only want to be trading during these very big times. When there's a big pump, you want to be looking to trade a portion of the move down. And when there's a big dump, you want to be trading a move up. Those are the only two times that you want to be trading. If you follow those rules, you'll pretty much never lose a trade, and you're always going to be in proper position. After a big crash, you do not want to be looking for short positions, and after a big pump, you do not want to be looking for longs. If you follow these rules, you will be winning. I hope that helps. If it does help, make sure you guys give this video a thumbs up, and I really highly suggest that you trade over on Blofin. See ya.